So this is a trade in the S&P 500 using weekly expiration cycle. August has August monthly, and they have August weekly. There's not a whole lot of difference between the two expirations other than the monthlies stop trading on a Thursday, with Friday opening print being the settlement for the monthly options, and the weeklies continue to trade on a Friday on the day of expiration, and they settle after the close. It doesn't really make a big difference for me personally because I plan on being out of this trade before the expiration. With this trade, the trade setup is number one, I look at time until expiration. So I like to go out at least, ideally I want to be somewhere around 60 days until expiration. It just so happens that August is 63 days, which is perfectly fine. I like to be somewhere around 56 to 65 days to expiration. So August cycle fits perfectly. The idea here is to buy a 25-point wide put debit spread and sell a 50-point wide put credit spread. Both spreads will share a short strike, and I'm looking to collect net credit for the trade somewhere in the neighborhood of about $2.50. It could be $2.60, it could be $2.70. In the trade that I put out today, I was able to collect $2.80 as credit. So what I did was I bought 39.25 put. I sold 2 of the 3900s, and I bought 38.50 put. This is a broken wing put butterfly, 63 days until expiration, and I was able to collect $2.80. My plan for this trade is looking at the price chart. We're starting to move to the downside. I don't know how deep this correction may be. I do see some potential support in the neighborhood of 40.50 on the S&P, with a potential retest of prior resistance, which should technically be new support in the neighborhood of about 39.85, maybe 4,000 on the S&P 500. I potentially will look to add around 40.50. So today I initiated a trade for 280 credit. We get down to about 40.50. I will add a little more, and I will do so same exact strikes. So same exact structure in the trade, except I'm going to look for a credit, not 280, which is what I got today, but the credit should be somewhere in the neighborhood of about maybe 450, 480, up to $5. So that is the idea for this trade. I did get a fill. I used weekly expiration cycle. 280 was my credit. It's currently going for about 290. So as the market is pulling back and an implied volatility is rising, we should be able to potentially get same or slightly better fills. As far as adjustments for this trade, on the downside, as I mentioned, I'm looking to add more as the S&P might pull back towards 40.50 down to about 4,000 level. And if we do find balance somewhere around 4,100 and maybe we trade sideways or higher, there's very little to do as far as this trade goes. And best case scenario for this trade is that if, let's say 2 weeks before expiration in this trade, so we could look at about T plus 48 with, so this would be with 15 days or about 2 weeks until expiration. If we are somewhere north of, call it 40.30, this is going to be a profitable trade. And if we trade to the upside on the S&P. So we rally north of 4,400 over the next 48 days. This trade could potentially be at a max profit, and the max profit in this trade is credit that we collect upon entry. I hope this is clear. This is the idea of what I'm looking to do with this trade. And as far as a stop loss for this trade, if we break even point to the downside, which is around 38.75 or so, I'm not going to look to do any fancy adjustments. I would just consider closing out this trade for a loss and initiating a new trade, similar structure, with about 65 days or 60 days until expiration. Again, buying a 25 point wide put debit spread and selling a 50-point wide put credit spread, looking to collect somewhere about $2.50, maybe $2.80, maybe even $3, depending on where we are as far as S&P goes.